Indian rupee falls to a fresh low versus the dollar. Let us invite Latha for her editor's take on the rupee today. Latha? Well, it is a shock that the rupee has fallen so rapidly. The fall from November 14th, when the October trade data came, to today is a 3% fall in just a little over 3 weeks. That's a little rare. The speed of the fall from 88.5 to 90 to 91 has taken everyone by surprise. The triggers are known. It is largely the FPI selling day in and day out. It is either, 1,000 crores, 1,400 crores, or on a bad day, it goes all the way to 3,000 crores. But it is always a sell number. And that relentless selling is, the overall reason. The sentiment is again bad because the trade deal is not like round the corner. No one's speaking about it as if it's, month end or next month or something. That's also hurting sentiment. But aside from sentiment, it is this actual outflow of dollars by people selling shares, buying dollars and remitting it out. Now, importers were kind of comfortable when it was a 3% fall because it's the average depreciation the rupee faces year after year. But post this November fall, importers have been caught unprepared, unhedged. They've always been unhedged, largely unhedged. And now importers are buying in a hurry. So that's the added pressure. So you have the big FPI sellout, and now it is, not hot money selling. It's people like Prudential whose IPO ends now, and they're going to take their money. They would have perhaps already sold it in spot for all you know, because the delivery is only day after tomorrow. The pressure of sell like this is adding to adding against the rupee. The Reserve Bank is not seen defending any level, and the governor made it very clear on the monetary policy day yet again. He's walking the talk since then. Perhaps the Reserve Bank's view is that as long as people are determined to go out like a Prudential, they're not going to change their mind because of a different value of the rupee. Why give them an exit at an attractive level? Let the market take its own course. So for the market, the sentiment changes that the Reserve Bank is not going to help. So it's really a one-sided market. It's now very difficult to call levels unless you actually see FPI buying of shares. We are all waiting for that day.
Very difficult to call levels, as Latha very rightly put it so. And thank you for breaking that down for us on the currency. Now, this fall in the currency is despite the fact that the trade deficit for the month of November fell sharply because exports grew very strongly by 19%. Now, exports also to the US had also increased. Now is that was supposed to be one factor, right, Latha, to ensure that the rupee doesn't slide further? The trade deficit was a concern. That came in narrower than what the street was anticipating.
I agree with you. And therefore, let us count our blessings. The fall of the rupee from 88.50 started on November 14th, 15th, when we got the October trade data, which was very bad, a $41 billion deficit. So the expectation was when the November data came at a very pleasant 24.5 billion, hugely lower. The expectation was that the rupee will find its feet. It found its feet for all of half a day and recovered by about 10 pies. But we must not forget that the real economy is showing some very big positives, probably because the rupee has fallen. What we have seen is that goods exports have risen by 20% year on year, and they are up 11% month on month, November over October. Probably this is because the rupee is at a more attractive level. Our exports are selling better. Now, the key growth sectors have been electronics, which were doing well anyway. Electronics goods are up 39% year on year. And the number of 4.8 billion in a month is unprecedented. It's a new high. Gems and jewelry, which we thought will be impacted by the US tariffs in a big way, are also up 28% year on year. Either they're able to sell more to the US or they have found other markets. Textiles are struggling, but still up 7.9% year on year. Again, looks like they have found other markets. The best news from the export numbers came from marine exports, shrimp exports, which were seen badly impacted by the US tariffs. It is very clear from the data that they have found higher sales to China. And that's again added to this, huge 19% rise in exports that we have seen in November. On the import side, also, there's positive news. The two big items, gold and silver, are much less in November than they were in October. In fact, gold imports are at a 4-month low, silver imports at a 3-month low. Gold imports are also down year on year by 59%. The other positive, which has always continued, is services exports. That's up about 12% year on year. They've been on that position for a bit now, for many years now, growing by about 10-11% every year. And so if you take goods and services together, our monthly deficit outgo is only $7 billion. It's not much. It's just that it is not the trade deficit that is the problem. The problem is the financial market. The problem is the financial outgo. Nothing to do with the real economy and everything to do with the rate at which shares are priced. People are finding it attractive to sell at these levels. Hyundai found it attractive, LG found it attractive, Prudential finds it attractive, a whole lot of FPIs are finding it attractive to sell at these levels. So it's a financial issue, it's not a real economy issue.
So financial issue, not a real economy issue. Thank you so much for taking us through those details, Latha. But earlier, we also spoke to